Three things I wish I knew when I started investing. I believe all of us as investors, we make the same mistakes. We have the same story. We kind of go through the same phase. And this is why it's much easier and it's much cheaper to learn from other people's mistakes than you yourself committing those mistakes, losing money, and learning the hard way. So in this video, I'm going to share three things I really wish I knew when I started investing. If I did, my investment journey would have been 99% easier, would have been really smooth. So I'm going to share them with you. If you're a beginner investor, if you started investing recently, you're likely going to find a lot of value. So I really hope you enjoy it as always. Now, the first one, which might be a simple one, but it's much harder to implement it than to actually understand it. And this is the whole concept of Mr. Market. Maybe you heard it from Warren Buffett, you read it in the Benjamin Graham book, but it's really, really hard to implement it. And if you could truly understand what is the whole concept of Mr. Market, investing will become 99% easier. And then you're going to be looking at everyone else that's being upset when their stock goes down and happy when it goes up, and they have all kind of mood swings and they believe the stock is telling them something. You're going to look at them and you're like, you believe like you're from another world. Like you believe like you truly kind of mastered something, and other people are kind of carried away with their emotions. So if you could just understand this simple concept, investing will be much easier. Now, the concept of Mr. Market, I'm going to use a real life example to explain it to you. And let's assume you want to go out in the real world, okay? And you want to buy a restaurant business, okay? You find a nice restaurant you like, and it's a great location and everything, but the owner is really, really drunk. So he sits at the bar every day, he's drunk, and he makes you all kind of offers. Someday he want to sell it to you for 200,000, another day for 100,000, another day for 300,000. Now, if he keeps changing the price, would you go out and say, okay, I'm going to buy it for 200,000 because you're scared he's going to take it to 300,000 tomorrow? Of course you wouldn't do that. How would you buy the restaurant? You would look at the financials of the restaurant to understand how much in free cash flow the restaurant is generating after expenses. And based on this free cash flow, you're going to make the decision of how much you should pay. It's not based on his change in mood and asking price. It's based on the free cash flow. Okay? So you look at the financial, you take out the rent, expenses, all these things. Let's say it generates 20,000 in free cash flow. Now you look at other restaurants for how much they're selling for, you look at the kind of value you're getting in the marketplace, and maybe your goal is to get your money back in 5 years. So 20,000 times 5 is about $100,000. So maybe you don't want to pay much more than $100,000 for this investment, okay? So you pay $100,000, you buy it from him, he accepts the offer and everything, then you're running the restaurant and everything is going really well. But then the person that sold it to you, he comes every night, sits at the bar, and he wants to buy the restaurant back. And he's really, really drunk. And someday he's going to offer you about 50,000. Now, in this case, would you get scared? Would you lose sleep at night? Would you panic because he offered you 50,000 and you're scared he might offer you 25,000 tomorrow? Of course, you wouldn't sell it to him for 50,000. Why? Because you know the restaurant generates 20,000 a year in free cash flow. So 50,000, you could get it in about 2.5, 3 years. So why would you sell it to him for 50,000? You wouldn't do that, okay? But someday he might come in really drunk. He might offer you 400,000. This is like 4 times more than what the restaurant's actually worth. Maybe in this case, you decide to take advantage of him and sell it to him for 400,000, use the money and buy a cheaper restaurant. This is what investing is about. In investing, the whole market is called Mr. Market. And Mr. Market is really drunk. Some days they might offer you very cheap prices because of a war in Iran that doesn't really affect the business. And some days they might offer you crazy prices like in 2021 for a company trading at 100 times sales with almost no sales. And maybe you're going to consider taking profits on this investment and moving it to something else. But investors, they don't understand this concept, and they let the market take advantage of them. They let the market tell them what to do, tell them what their stock is worth. If the stock isn't moving, they believe the market is telling them something. But in investing and in stock picking, when you buy a stock, you're buying a piece of a business, just like you're buying a restaurant. You don't make the decisions based on how the stock is doing. You make them based on how the business is doing. And it's those earnings that determine the value of the business over the long term. So if you just understand this really simple concept, You would not get upset when your stock goes down. You might get happy if it goes down because of the war in Iran. That doesn't affect the free cash flow of some utility company or Amazon or whatever kind of stock you're buying. And if the market is too euphoric and they're giving you Amazon at, I don't know, 300 PE, maybe you might decide to sell it to them. But you have to be the one that takes advantage of the market, not the one that's being taken advantage of. And the only way you could do that is if you're focused on the numbers and if you treat every piece of a business like you're buying the entire business. If you just understand the simple concept, investing will become 99% easier. And I hope I was able to explain it to you. Now, the second thing I wish I knew when I started investing is the whole thing with the hit rate. So a lot of newer investors are obsessed with having a high hit rate. They want to be right as many times as possible, and they never want to lose money, never want to take a loss, only sell at break even. And they're really against the idea of losing money. And they believe that in order to be successful, you have to be right as many times as possible. But this is not what happened to Warren Buffett. Warren Buffett's hit rate, so his success rate, you could say, is about 4%. So about 96% of Warren Buffett's investments either did not work out so well or they never worked out and he lost money on them. 96%. And he has one of the best records of all time, compounding 20% annually for like 50 years with a 4% hit rate. So what makes you believe that every investment you buy is going to be the next, I don't know, Palantir or is going to go up hundreds of percent? What makes you think that you're better than Warren Buffett and every stock you buy has to work out and you never want to lose money? Now, Buffett did it with a 4% hit rate. And in the 58 years of running Berkshire, there were only 12 decisions that pretty much made his career. Only 12 decisions. One of them was Geico. One of them was, I believe, See's Candies. One of them, I believe, was a railroad kind of stock and a few other companies. But it was only 12 decisions. This is all it took in 58 years to generate life-changing returns. So investing is a very forgiving business. You might lose some money, you might have some things that don't work out, but investing is all about preparing for, you could say, your next Palantir, or preparing for your next Tesla, preparing for your next Nvidia, preparing for your next whatever. It's all a combination of lessons that you learn, and you apply them to this specific investment once it shows up. And once it shows up, you are mentally ready to take advantage of it, to not sell the stock just because it went up, to not, you could say, buy it and then sell it or do all kind of crazy things. You buy it and you let it run. And this is what I personally did with my first 1,000% gainer called Mama's Creations, which I bought at $1.74. It's almost 1,000% gainer, and it's a food company. That was a combination of many mistakes I learned throughout the years. For example, I bought the stock when it was up 40% in 3 months. This is something I wouldn't do before because the stock is up. I believe I'm late to the party. But I should not be looking at the stock. I should be looking at the business. How much is the business worth and the potential of the business? The second mistake I used to do is I used to sell too early. Oh, the stock went up 50%. I need to sell because it's going to go back down. But maybe earnings went up 50% or 100%. In this case, maybe the stock is cheaper. So why would I sell it at $4 because I bought it at $1.74 and it went up? If the stock has $20, $25 on the upside and it's still trading at 15 times earnings, growing earnings 20%. So all those things were a combination of mistakes. And I had that one stock. It wiped out and it forgave me on so many losses, so many mistakes I had. I had Robinhood 2 and Hims and Hers and a few others. But I also had some losers along the way. I had stocks that didn't work out. And that's okay because I kept the losses small. And the ones that did work out, they wiped out all my losses and they gave me pretty amazing returns over the years. So investing is not about being right as many times as possible. It's all about getting it right a few times. Maybe you get a COVID crash and you get it right on a few stocks. Maybe you got some stocks right in this one. If maybe you missed out, maybe the next one you're going to get some things right. But it's all about preparing for the next one. And Warren Buffett, which is a funny story, he actually held 60% of his stock less than a year. So people believe he's a long-term investor, but he's not. He had a lot of losers, a lot of stock didn't work out, but only 12 decisions pretty much made his entire career. So again, what makes you believe you're going to have more than a 4% hit rate? Or what makes you believe that you're going to be right 100% of the time. Now, the third thing I wish I knew when I started investing, and that's a personal one, it's not maybe as common nowadays, but I skipped a lot of the big seven. I skipped Amazon, I skipped Meta, I skipped Google, I skipped Nvidia, I skipped all of them. The reason why I skipped them is because of the market cap. So I was looking at, say, I believe Google in 2017. It was trading at like a $300 billion market cap. I'm like, the company is $300 billion. How much bigger could it get? So I'm gonna go find a small cap, find some other company. But those companies today are trillions and trillions of dollars. In 5 to 10 years from now, they could be tens of trillions of dollars. So I made the mistake of skipping a stock just because I saw, Amazon is too big. How much bigger could Amazon get? And then Amazon gets even bigger and bigger and bigger. So the law of large numbers, it does work. But on some companies, it doesn't really work. And if you really look at the business itself, like let's say Amazon with cloud and the cloud penetration worldwide, you'll know that the runways on those businesses is much, much longer than 5 or 10 or 15 or 20 years. And I would not skip a stock just because there's a mega cap or the market cap is high. I would just look at the business and try to not look at the market cap as much. And that was a big one that costed me a lot of money. I just wanted to talk about it. So I really hope you enjoyed this video. I have many more of them and I share everything I do in real time in my group. This is a link if you're interested. But thank you again. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.